Divi's lab reported a weak performance on the margin front in its latest quarterly result. EBITDA margins contracted by 630 basis points on a sequential basis, mainly due to a dip in gross margins and rise in other expenses. Excluding forex gains, EBITDA margin came in at 35.1%. While margin headwinds require a close watch, it should partly mean revert in the coming months as prices of solvents and basic chemicals have moderated. We believe investors should focus on the long runway of growth as the benefit from investment behind productivity, new product range and green chemistry unfolds further. Q1 FY23 gross profit was impacted by lower contribution of the high-margin custom synthesis business along with rising raw material prices. Custom synthesis contributed 53% to sales in Q1 compared to 59% in FY22. Capex budget ramp-up is a function of the Kakinada plant. Work in progress Capex stands at close to 500 crores and 80% of this is expected to be completed in FY23. Furthermore, management has guided for about 550 crore Capex in FY23. While this is significantly lower than the Capex intensity in the last few years, this projection can be revised upward if Kakinada project goes ahead. Do remember that the Kakinada site has 100 acres of land and can take care of next 2-3 years' demand. Most of current investments cater to creating capacities for new generic molecules which are going off patent, contrast media investments and sartans. Divi's is also working towards hypoconjugate drug-related technology and peptide chemistry. At the same time, the management plans to allocate funds to modernize legacy plants for better productivity. The company's balance sheet remains strong. This keeps it future-ready for investments. In addition to that, the company has 350 acres of unused land with infrastructure for future opportunities. Overall, Divi's currently has 6 manufacturing units at 2 locations, Vizag and Hyderabad. Of these 6 units, 2 were set up in FY20 and are now fully operational. Since 2018, more than 2,500 crores have been invested in new technologies, upgradation of plants and processes, and yield improvement. Now, this helped double the fixed assets, mainly plant machinery and equipment, compared to FY18. Some of these capacities are still to get on stream. Now, 2 blocks are available for commercial production. In addition, current capacity utilization of 83% also provides headroom for near-term growth. We remain structurally positive on the custom synthesis opportunity, even though FY22 had a high base. Global pharma majors will continue to look for drug discovery and manufacturing partners in India, given the technical know-how, talent pool, and proven track record. Remember, about 90% of the company's sales are from exports. 44% sales are from US-based pharma companies and 33% from Europe. With respect to APIs, nearly 16 products are under various phases of development and are expected to benefit as they go off patent in the next 2 to 5 years. Between 2023 and 2025, management expects that drugs worth $20 billion are going off patent. In the near term, operating margins may remain under pressure as the management has guided for more than 40% in FY23. As the guidance includes other income, this translates to current EBITDA margin of 36 to 37%. We have therefore toned down our estimates as well. Now, in the longer run, however, we believe the company should benefit from recent investments on improving yields and backward integration. In addition to that, the company's focus on green chemistry helps it reduce wastage through tech adoption, leading to better profitability. Now, the epilepsy drug levetiracetam has been highlighted as a key drug wherein the company has optimized resource efficiency. Green chemistry has also helped contain impurity levels. Divi's has good control of impurity issues with regard to sartans. Management asserts there are no nitrosamine or azido impurities in the sartan APIs. In recent years, Divi's has expanded into all major sartan APIs based on the strength of its backward integration. The stock, if you look at it, has corrected by 30% since October 2021. After tweaking our near-term earnings estimates, it's trading at 22x FY23 estimated EBITDA. Though valuations are still at a premium to the pharma sector, and in our opinion, one should utilize the current phase of market to accumulate this particular stock. We continue to like companies like Divi's Labs, which benefit from economies of scale, vertical integration and pricing power.